Hey, guys, ladies and gentlemen. It's exciting again to be here today, but today we're here with Gordon Scott. So, Gordon, first of all, it's a pleasure having you here on our show, the TradePod. Um, and I'm super happy and I'm super excited because of today's guest. I have read a lot about you and I have heard your stories and we know each other previously and I really getting excited by each every single time I do bring something or someone that will share value to our audience and will be able to spread his message globally. And you, Gordon, you're one of the people that I believe that people will enjoy listening to. So, first of all, it's a pleasure meeting you. It's a pleasure having you here on our show, The Trade Pod, and I'm super grateful for the opportunity. So, how are you today?
I'm doing well. Thanks for having me on your podcast.
Thank you for being here. So, without further ado, tell us a little bit more about yourself. I do know you, but what about the other people? Come on,
All right.
don't be.
Well, I'm probably one of the more influential people in technical analysis that you've never heard of. And that might seem like
You're
an over, but I'll explain why this is true. 20 years ago, I guess almost 24 years ago, I kind of got started myself just trading. I had worked for IBM for 10 years and I had my 401k account built up to almost $100,000. And it was just sitting there. But I had some good luck with it. I mean, in the late 90s, everybody had good luck with their 401k. But I
Mhm.
had actually taken to, because in the IBM 401k, there wasn't a way to, pick individual stocks. It was 10 mutual funds and they all sucked. There was one individual stock, however, and it was IBM itself. And so I thought, okay, you know what I'm going to do is I'm going to try to trade in and out of IBM shares when I think there's something going on with the company. And it wasn't so much trading because, 401k, you got to hold it for at least 2 months back in those days. That was so it was more like active investing kind of stuff. But there was a time where the press outside of the company was really bad, and the stock price had dropped down as low as $50 or something. And from my vantage point on the inside, I mean, I wasn't an insider. I wasn't way up in the ranks. I was a kid 5 years out of college, but I could tell. Yeah, this is interesting because IBM had the internet before the internet, sort of. What I mean by that is
Right.
nowadays you got message boards and whatever and Reddit and but even at the beginning of the internet proper, around late 90s, early 2000s, you had a lot of message boards that were coming online and browsers and people, Netscape and all this stuff were they were starting to kind of communicate information in this organic and viral manner, but it was all just text, forums, message boards, that kind of stuff. I mean, early versions of what Reddit is today. Well, see, IBM
Mhm.
had that internally. They were this, global 400,000 person company, and they had message boards for the techie type of employee inside IBM to share information with. Hey, I'm working with this customer here. They want to know, you got a piece of code, the blah, blah, blah. And people would share technical ideas and information back and forth all around the world. And it was kind of an unknown, but highly, from a technical worker's point of view, very valuable resource. You go around a couple of departments around you if you're a coder or a information developer, as I was, and say, well, did anybody know anything about this? Anything know about that? And they'd be no. But then you'd get on here and you'd spread it out to 400,000 employees in the IBM world, and somebody would know. And I became actually the world's expert. I mean, it was this tiny little niche, but it was a precursor to HTML. It was IBM's own internal online help language, markup language called IPF, and it was really, really super nichey. But the IBM consulting folks had the ability to like put me out on site with a customer and pay me $30 an hour and charge them $300 an hour, and that's the IBM way. Anyway, so back in those days, through that mechanism, it functioned like the internet functions today, and IBM had it going all the way back to early '90s, even late '80s to some degree. And so the reason I bring that up is that through that mechanism, I could tell, communicating with people, that the company was not on the ropes. It was actually fixing a lot of things and really strong. So I would buy in when I could kind of see that. I'd have to hold for a year or two, but eventually I'd end up making a great return. And over the course of about 6-7 years, I doubled my 401k account. That's independent of contributions and risk-free interest rate and all that stuff. So early in the year 2000, I thought maybe I should learn about trading because I left IBM to join this startup that was all about outsourcing and consulting. And there were a ton of those companies in 1990. And there was a ton of those companies all went bankrupt in 2001, and I was part of one of them. And so I found myself with what the heck am I going to do? My career has gone great up until now. All of a sudden, nobody wants to hire me for less than half the pay of what I was getting. So I started studying trading at that point and looking at software to help me with trading. And so that's kind of where I got started. And then it took about 2, 3, 4 years of me just really digging deep and learning about trading myself. And I found that I could do pretty well. I was outperforming the markets for the first 3 or 4 years of doing that. I had learned a ton. And then I got the opportunity to become a coach with Investools. This was 2004. And so I went from being a coach in Investools to being the head of Investools curriculum, their content director for online and printed, all of the education over the course of about, I guess it was only 3 years. And then from there, I was in that position when Investools and and Thinkorswim merged, and was also there when TD Ameritrade came in and bought the whole thing. So I had all of this information and was in charge of this library of information, which was investor education. And it was really some of the best that was out there. I mean, compared to what we have today, it was not all that great, but it was pretty good. And when I put it together with the Thinkorswim guys, Tom Sosnov and Scott Snyder and Scott Sheridan and
all the Scots are involved with trading.
Yeah. I mean, they were just they were the floor guys, the floor traders for options back at the SIBO before they left to start Thinkorswim. So their market knowledge was deep and rich. And I went out to Chicago to spend a couple of weeks there and get to know them. And then the months followed, I'd pick their brain and try and figure out how to fold their knowledge into the Investools curriculum. So that was what I was in charge of doing. TD Ameritrade comes along and says, "Ooh, this is icky, sticky stuff. We don't like it. There's too much risk here. You're telling people to trade options." And I said, "Yeah, but we're telling them how to trade it safely." And they said, "Well, you've got to make this FINRA compliant." And so I spent the next year going through the whole curriculum with a team of people to get it to be FINRA compliant. And then I got the opportunity to work for the CMT Association. So I became the managing director of the CMT curriculum. And at the time I started, the CMT curriculum was just a list of books. 20 books on technical analysis, and then they had instructions, read this chapter, these pages, and so on and so forth. You had to actually go out and buy all 20 of these books and then read through little bits and pieces and then be prepared to take the test. And I mean, the CFA started that way,
Do you really think,
decades
Gordon?
ago.
I'm sorry for interrupting. I do really want to ask you a question. Do you
Oh,
think
sorry.
that following those 20 books of that the CMT have provided you about technical analysis really labels you with an edge of how to trade the markets properly in a manner of technical analysis?
Yeah. Well, it definitely
Really?
did. But more important, when we got together, or when I got into the position, Wiley Publishing came to the CMT and said, "We want to create a curriculum that's all in a single book. And you can use any Wiley book out there you want and just tell us which chapters and pages. We'll put it together for you because we have the rights to do that. And then you can sell it and we'll give you royalties for it." So our associate said, "Sure. Why, I mean, you make a great book and we get paid for it. Why wouldn't we do that?" So everybody loved the idea, but then they said, "Okay, Gordon, figure out which books and pages need to be where." And so it wasn't just 20. Now it became 200 books that I had to pour through and read through and study and pick out. And I worked with the curriculum committee, 6 other people, and we kind of debated, should we use this? Should we use that? What do you think? Here are my recommendations. So I got this really extensive education on just everything to do with technical analysis for forecasting, for trading, for risk management, for algorithmic, all of it. And so that was an even bigger personal edge to me, just to be able to have all that knowledge bouncing around from 200 different books that I had to read through. We didn't use all 200 books in the curriculum, but I had to be able to say, no, this one's better than this one because, right?
Yeah,
So yeah, that work
you
was,
compensate on the knowledge base. So
yeah,
you know
yeah,
what?
yeah. And so,
Shit.
so as a result of creating all that curriculum in Investools, and actually I ended up consulting with about 20 other companies to do the
Mhm.
same kind of thing. And then working for the CMT, I've got my fingerprints on most of the technical analysis curriculum that people are likely to come across nowadays without my name being out there or anything. So, and the CMT, of course, educates the top tier technical analysts in the world, and all the curriculum we have is all based on that stuff that I put together. They keep adding and refining the curriculum, and just this past summer, I was honored to be asked to write their chapter on the efficient markets hypothesis, which I just submitted to them. So their 2025 curriculum will actually have my
What do you think
name on
about
one of
the
the chapters.
what do you think about the efficient market hypothesis? What is your hypothesis about over the knowing hypothesis?
Yeah, yeah. So let's see. I'm trying to think of the time frame. It was about 12 years ago, maybe a little longer. I had this moment in time where I realized the efficient markets hypothesis says that technical analysis is hocus pocus. It's BS. You can't use it to beat the markets. Period. End of story. Right. Now, actually, the efficient markets hypothesis does not say that, but that is what most people translate it into saying. I remember going to a professor at a top university, talking to him about technical analysis and the CMT association, and his response was, "I wouldn't let you in front of my students ever because technical analysis is just a non, and he just went on to be dismissive of it." And I thought, okay, don't start being mean. Don't say rude things back. And so he goes through it, and then he takes me. He says, "You want to see what we teach students? Let me show you." He takes me over to this room where they've got basically a student-run fund, live money, $750,000, and they're trading on rules that he has taught the students. And I said, "Wow, this is great. What kind of entry and exit rules do you have? Because if you're trading, then," and he wasn't high frequency trading, but he was like position trading. I said, if you're trading, then you should have an exit rule." He says, "Yes, we do. We have an exit rule, and that exit rule is if you underperform the market by 20%, if a stock underperforms the market by 20%, then we sell it." I thought, Okay, 2008,
Yeah.
the markets went down by 45%, and you're going to let a stock go 20% lower than that, and that's going to be your sell point? It's like, that doesn't sound like much of a stop loss to me. So anyway, he shows me that he's got about 300 different fundamental ratios, price to book, book to value, on, and some that they've made up on their own. And then at the very bottom of all of it, he's got this little relative strength index chart. Like, what's that doing there? Why is this on your spreadsheet? He says, oh, well, we just kind of use that for timing. That's technical analysis, you bozo. If you're going to tell me it's all fake, why are you using it? That's the one indicator they were using for entry timing. It's like, okay.
You know what, Gordon, I do have an idea. Um, I would like to now. I understand that you are the greatest man to approach with when we want to speak about technical analysis and price action. Um, please explain to us why do you think it's such a powerful tool, and how do you leverage it within your day-to-day trading?
Okay. So,
And of course, you have like billions upon billions upon billions of videos and courses about price
yeah,
action and technical
yeah.
analysis, and do this ascending wedge and this, I don't know, ascending triangle, descending triangle, so on and so forth. All those patterns, I don't think we can leverage them. So if you would like, please present your screen, tell us what do you say, and please explain us what do you do. That will be the most powerful.
Okay. Sorry, I'm taking too long to answer these questions for you, but the backstory there, so that I can explain to you what I'm about to get to, is I had to have my own understanding whether or not people like this professor were right and there's no value to technical analysis, or whether there's really something to it. So I went out and did my own testing on patterns, price patterns, and various other things. And what I found was that professor and that point of view, the efficiency market hypothesis, it was right more often than it was wrong. And so I had to reconcile that. I'm like, well, look, if markets are really random and randomized, why can I have any hope of doing better with technical analysis? So I really had to study what was going to be the philosophical reason for expecting to be able to beat the markets with technical analysis, or really with anything, because his point weirdly was technical analysis is hocus pocus, but I mean by that same logic, so is anything that you try from past information, earnings and so forth. There really isn't an edge for any of those kinds of information that are publicly available, at least not by large scale tests, And that's what I discovered is I went through that. I looked for them and test on test on test that I did for myself. I couldn't find significant edges. I did find one weird thing though, and that was that trending strategies tended to perform a little bit better, about 3% over and above random. Now, let me explain to you how I began to think about this, and I think it's extremely important for every algorithmic trader to start with this as a baseline. If you're already there, great, you're ahead of most people. But most people I talk to, even in the professional space, are not working from this understanding, and it is to their detriment. So here you go. If you start with the idea that market prices are random, right? Now, what I do is I say market prices are randomized, because I know that there isn't any machine out there that's just spitting out random prices. Every price is deterministic, meaning somebody wanted to buy or sell and move the price to that level. But the cross currents of all of the millions of decision makers throughout the world in all the various different markets, they create a randomized output of data. So that's the way I refer to it, as randomized. So if you assume that markets are randomized, then it should also be true that a simple proposition like this, I buy here at price X, let's call it 50. 50. I buy at 50 and I set a stop loss at 45 and I set a take profit at 55, right? That's $5 down, $5 up, or you could call it 10% down, 10% up. I found that the percentage or the nominal amount doesn't really matter. It's the comparison, the distance, or I should say the proportion of the distance up or down, or down or up if you're going short. It's the proportional distance between your stop and target that really makes the difference. So follow this proposition. If I buy and I have my stop and my target equally distant from my buy price, randomized data dictates that I should win that trade 50% of the time. Plus or minus maybe a point and a half margin of error, fluctuations going on. But generally speaking, do that trade 1,000 times and you're going to come out with something close to 500 winners and 500 losers. That makes sense?
Yeah, that makes sense. But I would like to get more in depth within that theory, if possible.
Yeah.
So can you please let's take it a bit more narrowly down. So you say it's a 50-50. That
Yeah.
approach is equal to 50-50 scenario. So I would
Yeah.
like to make your life a little bit difficult, and I would like to ask you, all right, under what market conditions do this hypothesis really comes to life properly as you describe it? And is it really a necessity of a certain market regime that will impact the entire success rate by to your hypothesis by the end of the day? Because that I think that's what how you should approach markets.
Yeah.
At least
So,
in my point,
so
I would like to get more educated by
yeah.
by your
So
hypothesis.
follow me on this because I think
Sure.
I'm going to go right where you want to go. If I say it's a 50-50 trade by risking
Mm,
one to make one, right? Reduce it down to that language. I'm going to
yeah.
risk one to make one. So if my risk and my target are equal, it's 50-50, right? That's assuming randomness. In order for me to have the ability to trade, I need an edge. I need to be able to make trades that are somehow selective enough that I can win that trade 53% of the time or better. If I win it 53% of the time, I have a 3% edge over random. Follow that? Now, okay, to answer your question, are there markets that inherently have an edge that would give me, say, for instance, 3% gain on 50%? And my answer is no. I have studied Forex, futures, stocks, options, US stocks, international stocks, and I have not seen any of these markets provide an edge as a market. I will say that for long periods of time, I have noticed this generalization that US stocks tend to make money better with trending strategies, and Forex markets tend to do better with reversion to the mean strategies. Now, the year 2022 was a massive exception to that. It was completely flipped. And that had to do with the fact that the US was raising interest rates. So when the US starts raising interest rates, all of a sudden all currencies, are now affected by the US and the US pairs. And they now became trending because there was this upward trend as the rates started to go up. But that only lasted for about a year. And now we're back to this world where you make more money as a trader in the currency markets if you're working on a strategy that is a reversion to the mean rather than a breakout trending strategy. So that's something interesting to know. But I have
It
found over
is.
the years, go ahead, sorry.
No, it is. I'm saying it is. It is
Yeah,
a really
yeah.
cool thing to know. Yeah, I'm following. I'm
And
following you.
what happened that helped me prove that to myself was that a year ago, a little more than a year ago, a friend of mine who was formerly a neighbor, he and I had a conversation something like 12 years ago, and he came to me and he had this stock. It was a small price stock. He really didn't know the markets well, but he loved the idea of investing. And a broker had told him, "Hey, buy this stock. It's going to go 10x. You should really get in it." And he knew that I was in the market and knew stuff about the market. So he came to me and said, "What do you think? What do you think about this stock?" And as a trader, I don't care about any particular stock. I care about my trading plan. Get in at this level, get out at that level, take my profit at that level, and most importantly, risk a known quantity. So I asked him. I said, "Well, I'll look at the stock and see what I think about the chart and its trends. But generally speaking, I have to ask you 3 questions. Can you answer these 3 questions? Do you know where you got in? In other words, I believe this was a good point to get in. Do you know what your entry rules were? And do you know what your exit rules are, either for loss or for profit? And then last of all, do you know how much you're putting at risk? Deliberately saying, this is how much, if I get stopped out, I don't want to lose any more than this." Do you know the answer to those 3 questions? And he realized he didn't. And so he stopped talking to me. But he came back to me about a year ago and says, "Gordon, I've got something I want you to see." And he said, based on that conversation, that quick conversation we had over the fence as neighbors 12 years ago, I got to thinking about this idea, and I put this idea together, and now I want to show you this tool that I built. And so he had built this software based on something called genetic algorithms. I imagine you're familiar with those, Afek?
Yeah.
So genetic algorithms, for most people, for anybody who doesn't know, you can just just search for genetic algorithms on YouTube and look for the explanation videos that are somewhere in the range of 6 to 12 minutes.
There are many for genetic algorithms.
Yeah, don't spend any more than 10 minutes kind of getting familiar with it. But if you don't know, that's the easiest, quickest way to get up to speed. But generally speaking, let me just say, what you do is you take all the data that you want to test and you put it into a huge, long array, and that array is going to end up looking like a DNA strand. And if you treat it like a DNA strand, you can use it as a genetic algorithm to sort of take 2 comparative strands, test them against each other and say, this one's better. I'm going to now test it to the next one and go generation and generation after that and evolve a solution to whatever problem you're trying to come up with. He had taken that coding technique, that machine learning technique, and turned it on stocks. And after a while, it convinced him, hey, we need to do this with Forex too. So right now, it'll do U.S. stocks, most non-U.S. stocks, and it'll do Forex pairs. And it only does end of day, doesn't do any intraday stuff. I'm still working on him to try and figure that out, but he's just one guy, talented programmer, but he only has so many hours in the day. Anyway, so end of day stuff. And what he did is he created with a mechanism by which to say, if I know the symbol I want to trade, then what's the best way to trade it? And then this thing goes about trying to find at least a good enough way, because the best way, well, it turns out that with, somewhere like approaching 200 different technical rules and variables, it creates over 10 to the 240 possibilities, more than the number of molecules in the known universe, right? So you couldn't spend a lifetime even dividing that in half. So what he did is he thought genetic algorithms are a good approach to this because they start at some random place and then they evolve to something that's good enough. And if you like, I can actually demonstrate how that evolution process works. Would you like me to share my screen and just show that to you?
Yeah, with pleasure.
All right.
I would love to.
Okay, let me do that. I'm going to go here.
You right now you're presenting your screen.
You see it?
Yeah, we all see it.
Wonderful. Okay. So this is the name of the tool. We've decided, I've been collaborating with him over the past year to try to refine this tool. And we call it Edge Finder, with the idea that we're going to look for a solution that has better than 1-for-1, even if you were trading 1-for-1. Now, it's a little more complicated because, like, if you were to trade 1 to make 2, right? If I said, I want to buy 50, I want to sell 45, but I don't want to take profit until it hits 55, right? Then that's like $5 or 5 units down and 10 units up. So I'm risking 1 to make 2. That's no longer a 50-50 proposition. That's actually a 33%, 67% situation. And so in order for me to, sorry, the other way around, I'm going to lose that thing 67% of the time and win it 33% of the time. In order for me to make money in that trading setup, I have to win more than 33% of the time. So, hey, Edge Finder, find me a solution for something that will win more than 33% of the time, right? That's the kind of question that this software is designed to answer. So here's what we're going to do. I'm going to go ahead and log in, and I'm going to go to the evolution screen, and I'm just going to sort of demonstrate how it works. Now, if you can, off the top of your head, think of a trading symbol, stock, Forex.
Let's go for Euro USD. All right.
Okay, so if I put in Euro USD and I type .forex, right? What it's going to do is it allows me to specify either long only or long and short. In the case of Forex, I want to go long and short. And then it asks me to specify a training period. I'm going to go ahead and select the year 2000 up until about 2 years ago. Now, anybody sharp enough will know, well, wait a second, the euro wasn't around in 2000. Yeah, true. This data is going to go back to like the German Deutschmark and whatever. So it's got 20 years of data that simulates the equivalent of the Euro USD.
Yeah.
All right, so I'm going to specify a training period. We're going to build rules out of the training period from the year 2000 up until 2022. I'm going to make it hard. I'm going to say January 1st of 2022. That's right when the currency markets started changing radically. So
yeah,
I
remember.
Yeah. So in theory, if I built rules for 20 to 2022, or the very beginning of 2022, they should work poorly after, from 2022 until now. But if in fact I come up with a solution that works well out of sample, I'm going to be interested in that, right?
Mm-hmm.
Now I have the ability to choose whether I want to look at breakouts, continuations, or just reversals. I'm actually going to leave all 3 of these checked. There are some advanced controls here that I can put in, but I'm not going to worry about the explanation of those. And in fact, most of the time you don't have to. So you just put in Euro USD, Forex, long and short, do your training period, and then leave all of them checked and say evolve. Now, it's going to go load up all the data from that period of time, and then it's going to apply this 200 rule or almost 200 rule set of data to say which one of these rules, if I throw out this collection of rules, how would it trade? And then with each one of those, it's going to compare it to 100 others. So instead of a head-to-head, it's like a cage match of 1 against 99. And the winner that comes out of that turns around and goes into the next cage match, right? And we just keep going. And it keeps going until it finds that it can't find anything better for at least 10 generations. Meaning this solution is better than 1 in 1,000, right? So if it can find a 1 in 1,000 solution, then it's going to show it to me and say, consider trading this. And the rules will be really complicated. So
what do I see here? What do I see here on a screen?
Okay, here we go. So you see it's evolving, right? Let me actually open this up and we can see the evolution go as it's progressing. Here what we see is that it's going through, each time that generation number counts up. In fact, I'll zoom in a little so that it's easier to see. Right, we got 1 out of 4. That means we've gone through 4 generations, now 5. Each one of those is a cage match of 100, right? So in the first one, it said, okay, the very first one we started with is now we've gone 6 generations. This next one is, hey, I found something better in generation 3. Hey, I found something better in generation 5 and 6, right? Now, so we've gone 4 iterations where we've changed the set of rules, and the leading solution is this one right here. And what it does is it gives me the statistics of this. It shows that between 2000 and 2022, it made 2,000 trades during that time period. And that's almost 10 per month. It's like about 9 trades per month. And so it gives you kind of an idea of its trading frequency, right? Average hold time is 2 days. So this is a very frequent trading solution. It's not a, it's a swing trading solution. It's not some sort of active investing kind of. But here's the big number right here. The edge is 82 or 8.6%. Notice that the win rate is 92%. If I were to take 92% and slice off,
if I would like to convert that knowledge onto a strategy.
You what?
If we like to convert that knowledge, those stats, into a trading strategy, how do I do it?
So what we did is, because we found that, 2 things. Number one, we wanted to be able to get paid for the product. Number 2, it's actually really difficult to take one of the strategies from the Edge Finder and say, here's your 175 rules or whatever, and every day that goes by, go down your 175 list and tick off and say, is this an entry or not, right? So what we do is we say, I like this strategy, I'm going to select it, I'm going to activate it. When I activate it, it's going to just send me, black box, the next trading signal. But the next trading signal isn't just going to be buy. It's going to be buy at this price or lower. Here's your stop loss, and here's your target. And if it's a short, it's upside down, right? But it just gives you the trading signals as they come out. So as an example of here.
And how can we know that those signals are efficient and we can use them? So it's like, that system that you have been created is like a drain for people. Now I doubt. I won't say that I doubt. I would like to say that I would like to ask another question about the system itself.
Well, let me show you how I would evaluate this, and it might answer some of your questions. Watch this. See, on the last one, we're not all the way done with this one yet. But if I were to click on it and say, here, just show me the solution. What are the stats for it? Oh, right, it's not done. If I do that, I can save it, and then I can go here. Hang on, to my list, and then the Euro USD. That's the one I just saved. So here I'm going to look. I'm going to evaluate this solution more specifically. I click on it, and it's going to bring up the details. And what we've got here is this huge heat map that shows over time what the training trades look like. And this is the reason we stopped at 2002. I want an out of sample period. So the rules were all built on the training period, but if I then apply the rules, this is like back testing and forward testing, right? So you ask the question, how do I know that this is reliable? How do I know that it could actually work? Well, this is one of the ways how. I looked at the back testing data and I look at the forward testing data, and what I want to see is, did the edge that was that was calculated out of the back testing data, did it persist into the forward testing data? So we have that right here in this analysis data here. I show that the edge was 12.4% for all trade attempts. Not every trade attempt fills. See, these white boxes are, hey, here's a limit order, but the price never came down, didn't fill me, right? Green is,
I would have to stop you for a moment, just to wrap it all up for the audience. Like, if you will be able to please explain about in sample and out of sample periods.
Okay, so when you're back testing and you're doing any sort of algorithm development, you have to test based on some set of data, right? You have to say, I want to look at all of the stock market data going back to whatever date, or maybe I just want to look at 2007 to 2009 because I'm building a system that's going to take advantage of a bear market, right? So whatever you choose as the period of time that you're going to test on as your data, that's what you call your training data or your in-sample period, right? The in-sample period is where all of the rules get formed. In the case of EdgeFinder, it goes through and it does its little evolution thing based on that data and says, all right, what's the best way to trade the euro that I can come up with that's 1 in 1,000 rule sets better than all the others? And so it goes through and it runs it against that data. And then I say, all right. Historically, it should have done well. And this is the downfall of most backtesting and algorithmic development. They'll look at it and they'll say, oh, it tests really great in backtesting. And then they put it to use and it sucks. It just loses money, hand over fist, right? I mean, you've heard of that. You've probably seen people have that problem. Out of sample testing is designed to filter out those situations, okay? So in this case here, I tested all the way up to the end of 2021, and then the market did a weird thing, and I said, okay, if it worked really well here, I want to see if even a market change were to come along, would the rules still continue to work, right? So out of sample is, I've got 3 years worth of data or 2.5 or whatever amount I pick, and 2 years for these purposes turned out to be pretty good. If I've got this data that wasn't used to build the rules, then in theory, if I take this solution and I put it to use on this different set of data, then I might get different results. They might be horrible results, in which case I'd say, oh, I don't want to use this set of rules. But if they turn out to be really good results, then I have at least one point of evidence to say, maybe these rules will persist on their edge. Maybe the edge that it discovered will persist because there's some market anomaly that's still ongoing. Right? And so what I do here then to find that out is on these two tabs, I have in-sample stats and out-of-sample stats. The in-sample, as I mentioned, it shows my edge is 12%. Now I'm going to click over to out-of-sample and see for 2022 and forward, what did the same set of rules do? And notice that the edge dropped a little bit, but not a lot. It's 9.88, 9.74. So, I mean, you would expect some deterioration because the other stuff is historical.
How do you measure that number? How do you measure your edge over the markets? Like, which is almost, let's go for 10%. Let's go for 10% hedge. How do you manage those numbers? How do you evaluate?
Great question. Great question. So edge, as I mentioned before, you have to understand what your baseline win percentage should be. And you can determine that by what kind of rules you are using to set up your risk and reward. So as an example, if I say I'm going to risk 5 to make 1, right? That's sort of like saying 5/6 and 1/6, and I split them up. That's going to put me at something like 83.3333%. So I should win 83% of the time as a baseline, not 50-50. I'm risking 5. I'm going to have this huge, stop loss. I'm going to risk 200 pips to make, say, 30 pips. If I risk, when I lose, I'm going to lose 200 pips, but when I win, I'm going to win 30. So I'm going to have these small winners, but because I do that, without even trying, I'm going to win 83% of the time. Now, I won't make any money at 83% of the time, because when I lose, my losers are 5 times as big as my winners, right? Or more. And so I need to make sure that I have a better win percentage than my baseline suggests, the randomness suggests. And the edge is that difference. So if I say 10% is my edge, well, the system says I should win 83% of the time because of the kinds of trades I'm setting up, where I risk 200 pips to make 30 pips. But these rules historically show that I win 93% of the time, not 83% of the time. And just
So it's
that,
all about risk management. So
yeah,
those numbers rely on how do you manage risk, and if it was properly enough, you
yeah,
should be able to raise or to decrease the number of your edge. So I would like to go through the stats that I'm seeing here on the auto sample. So your ROI is 1.301.
yeah.
What does it mean?
Well, that means you see 1.301, and then over here versus buy and hold 1.35. They're kind of similar, right? In the case of
Yeah.
currencies, this is less meaningful because in the currency markets you always leverage anyway, right? But
Mhm.
if buy and hold, and this is, remember, it's only for 2.5 years. If you were to buy the euro at the top of 2022 and hold it until now, whatever amount of money you would make by doing that, this system is going to call 1.0. But the trading rules say that if you traded the rules instead of doing buy and hold, you're going to come out 1.35, or in other words, 35% better than you would have just against the euro. So that's what ROI, return on investment, and versus buy and hold are kind of pointing at.
This is awesome.
Yeah, pretty good, huh?
So
And so
yeah,
notice here,
pretty goddamn good. Congratulations on the work.
yeah, it's I'm you can see why I'm excited about it, of course. But here's the thing. I've actually been trading this with real money now for almost a year in US stocks and for about 3.5 months in currencies. And while it's true that you do have to do some risk management, you can't just say, oh, this one says I'm going to win, back up the truck, put all my money into the very next trade. No, don't do that. You're going to go bankrupt if you do that. But if you put on something like 2% risk on each one of these, it tends to trend, at least it has in my experience, trended to newer and newer highs. And I've been very pleased with this because, for years I've been trading well, but it's like I would have to spend an hour, 45 minutes to an hour a day evaluating my stocks or currency trades, looking them over, deciding, hey, what am I going to trade tomorrow? Where's my stop? Where's my target? So on and so forth, tracking it down. Now, with Edge Finder, I just come here to my trade signals tab, and it shows me all my different accounts and the trade signals I can get. Here's an example. These are my stock
Yeah.
signals.
Mhm.
It just tells me here are the 5 stocks that you should consider buying. And here's, if you do buy this one, here's Meta, Facebook, right? Right now it says buy Meta at 591.04 or lower. And if I click on that, it gives me the details. Buy at 591.04 or lower, put a stop loss, $5.91 higher, take the profit, 11.
1-to-1 it's a 1-to-1.
Actually, not a 1-to-1. This is a risk 1 to make 2.
Risk
That
one to make
particular one.
two.
Yeah, because I'm going
Yeah,
to.
now I see the difference. Yeah,
Okay,
now I
good,
see
good.
the
You're
difference.
onto it.
Now
All
I
right,
see the
cool.
metrics. Yeah.
Yeah. So this is a trade where if I make it, it's saying, hey, if you win this one, you're going to win big compared to what you risk. Most of the time, you will expect to lose this. You'll expect to lose this about twice as much as you win, 66% of the time. That's what randomness suggests should happen. But if I look at this solution right here, I'm going to click on this to see what solution generated this trade idea. And here's my metrics, right? This is showing me that I have an edge of a crazy number,
21%.
21%, right? That was the
Now the
inside.
outer sample.
And the out of sample, though, is still fun, 13%. So
Yeah, but the
instead
outer
of,
sample period is not that long as the previous strategy we have explored.
yeah, yeah.
So
So,
how efficient it is right now? If
So
the
this
outer
is
sample period
this
is
is
like
real
short.
time. That is to say, once I start tracking it out of sample, it just keeps following it from that point on. So real time, starting from the beginning of the year until now, it is a 13% edge. And so if I'm careful, right, it's like this is, I'm not going to win 33% of the time. I'm going to, and in fact, have been winning 46% of the time with these trade signals. And so I mean, think about it this way. If somebody came to you and said, here, let's play a game with a single die, it's a dice rolling game. And if I roll a 1 or a 2, you get paid $10. But if I roll a 3, 4, 5, or 6,
Sounds like a deal.
you pay me $5, right? Now, if that setup sounds like it shouldn't win anything, that's a zero edge game. But if somebody walks over to you and whispers in your ear, hey, that dice is rigged, it's going to roll a 1 or a 2 46% of the time, not 33% of the time, then what am I going to do? I'm going to say, you're on, buddy. Let's play. Let's play 100 times. Now, I'm not going to put all my money on the first dice roll. I'm going to dole it out little by little, but eventually that 13% edge is going to pay me off.
Do you have any track record to prove the efficiency of the system?
The most recent track record that I can share with you is on my Forex trading. So I opened a Forex account.
Let's do it.
I opened a Forex account 2 months ago. I'm trying to see if I have screen capture here, but I can just give you these numbers. I opened the track record, or opened a Forex account in the middle of July. Just put in $240 with the idea that I just want to make it small. And I want to test, and I want to risk a lot, and not just 2%. I want to risk like 10%. And so I know I could easily bankrupt the account, but at $240, I don't care. I just want to see, will it perform? What is the edge like? And it turns out, from that time until this, I've made about, I want to say, somewhere between 70 and 100 trades. And I have worked with 7 pairs specifically, and the solutions that I have for
the major ones. The major.
Yeah. I'll share with you my. Well, let me see. I guess I got to do it this way. Hang on. I'll share which ones there are. They're mostly majors, with one exception, and it turns out the exception I'm working on is the worst of them. So I have 14 different solutions, but they're specifically trading on these pairs: US yen, US CAD, Euro USD, Euro Aussie. Euro Aussie is the one that's, it's 2 different major currencies.
Less liquid. Yeah.
But yeah, it's like a minor pair, right? And Euro pound, pound dollar, Aussie dollar, and that's it. Those are the pairs. So I've just been working on those particular pairs, and I tend to get anywhere from 3 to 5 trading signals fed to me every day. If I have a position on already, my rule is I don't add a second position. So if I got a Euro US trade yesterday and I put it on long, and today I get a Euro USD trade short, I'm just going to ignore that trade until the first one has finished. Then I take the next Euro USD trade. So that's a little bit different from the statistics, because the statistics are counting every trade. But I figure, hey, if I've got 2,000 trades and it's showing me a persistent edge, then even if I get picky over enough trades, that edge should still maintain or be close to it. Well, as it turns out, it has. Over the past 2.5 months, I have managed to document a 7% edge in the training. In the live trades. So even across all 7 different pairs, I've got I'm winning 7% more than randomness suggests that I should be winning. I've also had the trade. It the equity curve. It fluctuates up and down, but it keeps making new highs along the way. The highest it made is about 15%. So 15%. Wow. Now, a month sounds fantastic, but don't forget, I'm risking like up to 10% on each one of these positions. If I were to dial that back to something realistic, like 2.5%, even for an aggressive trader. That's the sort of top end of what you'd want to do. If I were risking that amount, then I wouldn't be at 15%, but my top end would be somewhere around 3 or 4%. And 3 or 4% in a couple of months, I mean, that doesn't sound like much, but you extend that out around a year, and I'm really hoping I can achieve that for a year with this same system.
Got it. Sounds incredible. Like, and is that product is available to the crowd?
It is. So if you were to go to this website, geneticsfin.com, and you'll come here to the home thing, and you've got a sign up button where you just put your name in. This is just to get you on an email list, and then once you sign in, you get a choice to subscribe at one of these 4 different levels. We've actually made it possible for you to subscribe for as little as $5 a month. We're kind of excited about that. Now, there's some limitations there. You can only get 1 trading solution per day. So if I evolve 5 different solutions, and each one gives me a trading idea for the day, I'm only going to see the first one. So that's the limitation of the starter pack. But it allows people to kind of put their toe in and say, hey, could this trading work for me? Can I understand it? Can I kind of figure it out, and so forth, right? And if they do, then they consider moving up the chain. This one gives you 2 trading signals a day. This one gives you 5 trading signals a day. And the Pro gives you unlimited trading signals. As you saw, I have actually 25 trading signals coming in. Each one of the trading signals is good for 24 hours. For the Forex trader, it's really nice because those signals are available at 6 p.m., between 6 p.m. and 7 p.m. Eastern time, which gives you, a large window of time where you can make those trades. For the U.S. stock trader, those signals are available at the same time, but they're not valid until the market opens the next day. On the other hand, it gives you plenty of time to sort of look over the signals, strategize, put in the right order, and so on and so forth. So that's it. Your choices are those levels, and you can get going. We also do a once a week support call. We do this webinar. People log in, they ask questions. We demonstrate new things. We're constantly adding new functions to this, and so we help people realize what's coming. And there it is. There are also ways that you can take the algorithm that you selected, the solution, and hook it up to an automated trading system. It's only for 2 brokers, and it's only for U.S. stocks, unfortunately. But what that means is if you open an Alpaca account or you open a Tradier account, those are the 2 brokers that we have APIs established with. If you open an account for either one of those, then you can get your trading solutions and automatically move them into, so you literally just say, here's 5 trading solutions, check, approve, and off they go, and it just does it all for you. So that's fun. We don't emphasize that a lot, but it does work, and I have used that over the past year on my own trading account because I have a Tradier account.
Mm-hmm. Sounds good. Like, that system sounds good to me. I believe that once we will upload that video, people will go freak about it, because it really enables you to have an idea of how to find an edge, and you can pretty much assure that you do have an edge over the markets without even briefing and doing your over complete the over completion of the entire situation. But and that's why I think it is a really good system.
So that one we started evolving on the Euro, it now is finished. If you want, I can just show you the stats. We looked at an interim version of it, but here's the final version of it. It worked its way up through, I'm not sure how many generations, but as you can see, these are the stats. These are entirely the best
What is
solution.
what is the BCR? What is the BCR?
Yeah, you remember those check boxes
Breakouts, continuous
and
reversals. Yes,
breakouts?
yeah.
Yeah.
Check. Yeah,
This is
of
like
course.
how many breakout, how many continuation, how many reversal trades. So this one here you can see it's all reversal trades. Remember what I said earlier on that we found in Forex, you're better off doing reversion to the mean, or in this case, reversal strategies. And this is kind of proved out by the fact that most of the trading signals that it came up with were, in fact, reversal signals. And that was the solution that tended to do better than all the others. Because this is looking at every possible permutation it can think of within the confines of 100 at a time, right? And so here we see that over 20 years, 22 years, it made 2,653 attempts at trading. 64% of the time they actually filled. That's a really high number, actually. I'm somebody, I don't like to trade stuff that doesn't fill very often. But this one, as you can see, it doesn't have a lot of white boxes compared to green boxes. The green boxes represent it actually did fill. And so this is the type of solution I tend to really like. Notice that I'm going to go back to that previous screen though. See, I want to show you this stat. The average win percent is only 0.29. If you just translate that into pips, that's like a trade where you take 29 pips as profit, and for loss, it's 1.73%. That's like 173 pips. So you're going to risk 173 to make 29. That's the typical trade. It'll change back and forth. But you can see from that, you ought to be able to win like about 85% of the time or so, 86% of the time, somewhere in there. But this system has an edge of 11% historically in the in-sample trading period. Whoops, sorry, it keeps doing that. 11.2%. So your win rate is 97.5% of the time. And the maximum drawdown over 20 years was only 4%. That's another thing I didn't even mention before. This keeps track of what your drawdown is in the trading period. So you can see, like here in this solution, this solution allows for a 30% drawdown. It might be fantastic, but you got to be willing to put up with that. You got to money manage so that that doesn't mess up your stuff. This one, on the other hand, only docks you 4.71% in the training period. So what I really want to know is, how did it do out of sample, right? So now here I come to this screen, and I look over here at the out of sample. This looks like it has a few more losses than these over here. So I'm going to expect some deterioration. Let's see what we get. This is good. Edge is 7.37, and then for filled trades it's 7.19. So even though the training period was 11% edge, this is still bringing me a 7% edge in the out of sample. Now here's my little rule of thumb in looking at these things. I find that if two things happen, number one, when you go from your in-sample edge to out of sample, as long as you don't lose half of the initial percentage, then it's probably a viable trading system. If I go from a 20% edge to a 5% edge, well, 5% is pretty good. I got a little story about that, but that sort of, I've got only 25% of the edge that was there in the in-sample period. I don't want that solution because that edge is not persistent enough, and it might be too volatile when I actually go to trade it. So my rule of thumb is, as long as it maintains half the edge or better, that's good. The second level is it needs to be better than 4% edge. So it doesn't, if it comes up with a 7% and it drops to 3 or even 3.5, well, it's only half, but I still don't want it because it's not above 4, right? I want an edge that's at least 4% or higher. Here's where I came up with that number. This is a fun little story, if you got a moment for me to tell you this, about $1 million. When I was working at the CMT Association, I had an intern. His name was Max. And he was only about 20 years old at the time, but he had actually been trading for almost 10 years because he was just, as a young kid, really attracted to it. Earlier that year, he had taken his bar mitzvah money, $10,000, and he started trading it in binary options. Well, one day, we're talking about the fact that he's trading this binary options And I had this speech prepared. Oh, binary options are terrible. Don't touch them. It's a scam. You will lose your money, guaranteed, blah, blah, blah. I have learned not to discount any individual's trading strategy. There are so many ways to profit in the market. What one person can do, another person cannot. And so when he said that he was trading binary options, I thought, okay, just be curious and open. How's he doing? So I asked him, no, what are you doing? He says, well, I started this 4 months ago, and I'm up to $16,000, so I'm not sure. And I said, wait, you've made 60% increase on your bar mitzvah money in just 4 months using binary options? He's like, yeah, is that bad? I said, no, but tell me, I need to know a few data points, because now all of a sudden the gears in my head are turning. Like, is this sustainable, or is he just risking wildly and doing crazy stuff that's not sustainable? And I've got to warn him, hey, stop that, right? I said to him, Max, would you be willing to let me coach you? Because, by this time I had coached individual traders for almost 20 years. I've been doing that all along the way, either specifically professionally or just, side gig type of thing. But I continue to coach traders one-on-one for the situations where it makes sense. So at this time, I'm working for the CMT Association. I'm really busy, so I don't have any trading, coaching going on. But I want to coach this kid, because I bet my efforts would not be wasted on him. I said, I need to know how well you're doing. So I need to find out your win rate and your edge. And he said, oh, well, my win rate's fantastic. I'm winning like 90% of the time on my trades. And I thought, okay. In my head, I'm saying to myself, if he's risking 9 to make 1, then that's a break-even strategy. He doesn't have any edge. So I need to find out what his trading setup is by default and what his baseline win rate should be. So I said, well, okay, Max, what I need you to do is, for the next week, keep track of the distance between your entry and your stop loss and your target price. And then come back and tell me what that is. And then from there, I'll coach you the rest of the way. He comes back a week later and he says, my edge, or my trading setup is risk $75 to make $25. And I thought, okay, great, that's easy. That's risk 3 to make 1. And he should be winning 75% of the time. If in fact he's winning 90% of the time, he's got a 15% edge. No wonder he's making 60%, in just 4 months. And I said, Max, I'm going to ask you to do some things. I want you to do these rigorously for the next 2 months. First off, don't ever risk differing amounts with the trade. Stick to the same amount being risked for each one of your trades. And you can modify that at the beginning of each month, but for an entire month, don't make any. So if you only risk 1 contract, stick with 1 contract. If you bump to 2, stick with 2 the whole month. Okay? He's like, all right, fine, I'll do that. I said, now I need you to keep that same percentage, risking 3 to make 1. Rigorously stick to that setup. If you can't find a trade that setup works with, don't take the trade. He's like, okay, I can do that. After 2 months, he comes back and tells me my win rate is 79.2%. In fact, he divided up. He made a lot of trades. He had made something like 1,000 trades in 2 months, and he divided up by each week. Each week, it was like 79.2% plus or minus 1/10. So right there, 79%. And so his setup said he should be winning 75%, but in fact, he was winning 79%. So that told me, number 1, he does have an edge. Number 2, it's only 4%. But because he's making 1,000 trades every 2 months, he can profit from that. In fact, he did, I coached him and we got him to the point where he felt like his stuff could be consistent. He left the internship where we were and went back to school at the University of Michigan. And for the next year, he traded in between classes at the University of Michigan. And he made over $240,000. Oh, I forgot to mention, in those 2 months where he made 70% 9% wins on a 75% baseline. He took his $16,000 bar mitzvah account to $32,000. So not only had he made 60%.
I need to meet that guy. I need to meet that Max guy.
Yeah, well, let me tell you where to find him. Because what happened to him is he made $240,000 during his senior year at school. He went and did an internship with J.P. Morgan. He called me at the end of the internship, said, "Gordon, I'm in trouble." I'm like, "What's the problem?" He says, "I hate it. I don't want to work for J.P. Morgan. I don't want to work in investment banking. That was where I was targeting. It's horrible." I'm like, I know. You're in the wrong place. Here's the place you need to go. And I knew the guys over at a company called SMB Capital, Mike Bellafiore, and I'd worked with them. I worked for Investopedia for a short period of time, and so I'd had connections with them while I was there. And we were on very good terms. I emailed Mike and said, "Hey, Max, there's this guy named Max. You got to meet him. I think you should interview him. Consider making him one of your proprietary day traders." And so he did. For the first year, Max had to live on his $240,000 because he didn't make any money. But the second year, he made really good money. And the third year, he made over $1 million in trading profits. And you can find this guy just by Googling him. Here's his name, Max Ganek. And right there, his LinkedIn. I've asked him, and he said it's okay to tell people about him. There's his picture, right? And if you search for him on YouTube, Max Ganek, SMB Capital, you'll get several videos. They actually make videos with that guy. He's their youngest, most profitable. Well, I should say he is the youngest trader they've ever had to make $1 million in a year of trading, and he is also the youngest trader who's become a manager of other traders. So anytime he makes a video, I watch it now, right? Besides the fact that he was formerly my student and I rah-rah for him, but I mean, I learned stuff just from watching his stuff. So he's an amazing trader, but I like to say I knew him when. But he taught me the fact that you can make money on just 4% edge, just 4%. And so that was really eye-opening to me. And that's kind of what my baseline has been. I thought, well, if I can have at least 4% or more, I probably have a reasonably good trading system to work with. And so that's been my algorithm. I like, 5% or more for anything. And in the case of the stuff I get from EdgeFinder, I want to see more than or less than half of a deterioration from in sample to out of sample. So I hope that answers your questions on that.
Wow. It was a really comprehensive explanation about anything. And you know what, Scott? I really enjoyed listening to you and listening to your insights and what do you think about trading, and to hear the story about Max, and to really learn what you have experienced over time. And I'm incredibly grateful for that opportunity. And yeah, thank you for your presence here within the TradePod. I am super excited by sharing this with our crowd. I believe that they will be happy to receive such content, especially looking at the EdgeFinder and see what the capabilities of your software is. And I'm so grateful for the opportunity. Thank you for being here.
You bet. If you wouldn't mind, when you put this up, just be sure to put the URL up, genetics with an X, genetics. Geneticsfin.com. Yeah. Anyway, that's the URL where they can go if they want to go look at it and learn more and so forth. We haven't got a whole lot of marketing material up there yet. I'm interested in trying to put that together in between other things that I do, but right now it's just sort of bootstrap marketing between myself and my friend Bob, who is the genius programmer behind the effort. Anyway, it's been a fun collaboration, and we're just delighted to be able to share it at such a low price point for everybody.
Great. So I'm super happy for your value proposition for the entry point traders who would like to go and explore more and more. I think it is really powerful price planning, and congrats on this one. I will tell you, thank you for being here on the TradePod. again, and I really appreciate it. And thank you.
You're most welcome.
Thank you. Thank you, Gordon. I'll see you soon. I'll speak to you. I'll speak to you then. And it was a great time to meet you. Bye bye. Thank you.